Well, thank you everyone for being here this afternoon. Unfortunately, our president, Mrs. Pervenche Beres, can't be with us this afternoon, so she asked me to pass her on best regards and to thank you all for being with us this afternoon. And it is a real pleasure for the AFR to co-organize this seminar with the University of Orléans, and especially thank you, Anastasia Soteropoulos, for all the work we have done together. It was very pleasant. You all know what stablecoins are. You all know that they act or can be presented as, let's say, a bridge between what we now call the traditional finance and, let's say, the crypto world. They have one core characteristic, which is their one-for-one peg with fiat currencies, USDC and dollars and euro. This ensures at least three things. Firstly, they represent globally accessible store of value. They are presented often like very efficient cross-border transaction tools, and at the end, this enhances liquidity across digital markets. So before we're starting really the seminar, I just want to have some figures to know what we are talking about. And if some of you still think that stablecoin are just a new tool or an experiment, you might be surprised by those figures. I will invite you to step with me, to take a step back with me. First, last year, the transaction volume of stablecoin reached 35 trillions of dollars, which means that they're clearly outpacing Visa and MasterCard together. Secondly, the number of active addresses have more than doubled in a year, reaching about 30 million active addresses. And the total amount of stablecoin supply exceed more than 200 billions in February 2025, which means that it was more than 60% growth in a year. In short, you have an explosive growth and an increasing adoption. So when you know that, you have to have in mind landscape in stablecoin. It is quite easy. The landscape is quite clear. You have USDT and USDC, which remain dominant, even though new players are coming, and maybe we're talking about USDE from Athena. Yet, despite this rapid growth I just mentioned, stablecoins remain 100 times smaller than the total amount of M1 dollar value. And if you compare to euro, it's 50 times smaller than the euro M1 money supply. So even though they are not a niche innovation anymore, I think we can't yet say that they are a fundamental pillar of finance. The path forward is so very important and is also becoming clearer. In Europe, MiCA Regulation is bringing much needed clarity, maybe paving the way for institutional adoption, and I'm sure the industry welcomes that. But in the US, things are more uncertain. As you know, I'm sure, the new administration has issued, let's say, maybe not hundreds, but a great number of executive orders since January. And one of them is banning CBDCs, so the central bank digital currencies, while actively supporting stablecoins. And from my understanding, a working group has been set up to propose a federal regulatory framework within the next 6 months, so it's going to be quite fast. So here we are at a turning point. Institutional adoption seems to be looming, regulations are shifting, and the industry is evolving fast. This is why I'm very happy that we have this discussion today, so we can explore the challenges of stablecoin and MiCA regulation and how they can help to preserve Europe's strength and strategic autonomy, because this is what we have to have in mind, what discussion we might have. So thanks to all our guests for kindly accepting the invitation. Thanks again, Anastasia, for all the work. And Louis de Georges, you are representing Linkletters. So I know you have a few words to tell us, so I will now give you the floor. I wish you a good seminar to everyone. Thanks for being with us today.
Ladies, gentlemen, good afternoon. I wish you a warm welcome at Linkletters. So today we are pleased to host this new event co-organized by the AEFR and the University of Orléans, and this outstanding panel of experts that will be having exciting discussions about this very hot regulatory topic, stablecoins. Hot topic for, in my view, three main reasons. First, as all of you may know, MiCA, which definitely entered into force at the end of last year, regulates across EU member states the provision of services on crypto assets, including on stablecoins, which under MiCA are a subcategory of crypto assets. MiCA also addresses offering to the public and admission to trading of stablecoins. However, stablecoins raise a number of queries beyond MiCA. Indeed, certain stablecoins also qualify as electronic money. This means that the provision of certain services on these stablecoins could be viewed as payment services, which, as a principle, may only be provided by payment services providers. In this respect, particular attention will need to be paid in the coming months on the ongoing discussions between the European Commission and the EBA on the interplay between PSD2 and MiCA. Finally, stablecoins are also at the core of the discussions around the implementation of central bank digital currencies. At the European level, various works have been conducted over the last years by the ECB to implement a digital euro alongside physical money. While the industry would welcome a wholesale digital euro, and notably for settlement of tokenized asset purposes, a recent report from the ECB casted doubts on the need for consumers of a digital euro as a new payment method. Thank you for your attention, and I wish you a great conference. And now I will hand over the mic to Anastasia.
So, ladies and gentlemen, dear colleagues and friends, I would like to warmly thank the IFR for the organization of this event, and also the Institute Louis Bachelier for its valuable contribution. Our keynote speaker today is Donato Messineo, that did us an honor to come from Washington, D.C. today to join us and to present the international standards and practices. So Donato is a legal expert at the law department of the International Monetary Fund, and previously he has served positions at the European Central Bank and at the Bank of Italy. So Donato, the floor is yours.
Good afternoon, everyone. I thank Anastasia and the organizers for inviting me. I'm particularly glad to take part in this event, as it brings together speakers from the industry, the legal profession, the academia, and public institutions, and inputs from different perspectives will be beneficial to today's discussion. Stablecoins are attracting growing interest from market participants, standard setters, and regulators. And innovative legal thinking is required to address their risks and opportunities. My presentation will be structured as follows. First, I will point out the trade-offs underlying policy and regulatory approaches on crypto assets. Then I will introduce the notion and use cases of stablecoins, highlighting potential benefits and risks. And finally, I will give an overview of the international standards and practice developed so far to address such risks. Before I begin, I need to clarify that the views expressed here are of my own and do not necessarily reflect those of the IMF, its executive board, or management. The IMF has been collaborating with the Financial Stability Board to build a policy and regulatory strategy on crypto assets. Regulatory responses seek to address risks arising from crypto assets without stifling the opportunities connected to fintech innovation. Such responses must fit smoothly in the legal and institutional structure of member states, and to this end, international standards are high level and just set objectives that can be achieved through different solutions by member states. However, fragmented national approaches may be ineffective, as crypto assets are borderless in nature and operations, and therefore regulatory approaches need to be comprehensive, consistent, and coordinated across jurisdictions. On top of that, cooperation and sharing of information among national authorities are of the essence. As a matter of fact, legal frameworks on crypto assets still broadly differ. Some jurisdictions face challenges in the implementation of the recommendations due to lack of resources, lack of data, lack of a common taxonomy. However, the first building block of national legal frameworks should be the strengthening of legal clarity in different areas of law related to crypto assets. Notably, private law should be modernized with a view to clarifying the classification of crypto assets and rules governing their transactions, and this includes the fundamental question regarding the nature of the rights of crypto investors vis-à-vis firms and their treatment in insolvency as well. Are they proprietary rights unaffected by insolvency, or are they personal claim ranking pari passu with all the other firms' creditors? We know that courts in different jurisdictions are giving different answers to this fundamental question, which we're going to see is quite relevant in the case of stablecoins. Clarifying the treatment of crypto assets under financial law categories is also needed, and establishing transparent and predictable tax law frameworks for crypto assets. Legal clarity is especially relevant in the case of stablecoins. As I'll say in a minute, clear rules and transparent information on reserve asset composition, custody arrangement, and redemption rights is key in mitigating the risk of runs on stablecoins. Crypto assets advocates point out the benefits associated with them. Depending on the circumstances, they can include cheaper and faster payments, as certain technologies have a potential for avoiding or reducing centralized intermediation and the time and fees which come with it. Connected to these, crypto assets could enhance financial inclusion of the unbanked population, as users can obtain alternative access to payment services, again, allegedly at lower fees than those imposed by banks and just using their smartphones. Innovation and market competition. The source code of public blockchains is generally available, so further development and reuse are possible, and new financial services can easily be created. Transparency and traceability of transactions, as this would typically be allowed by the DLT architecture. And finally, decentralized finance is also presented as a potentially more secure means insofar as it minimizes risks associated with central points of failure. And benefits would be greatest in the case of stablecoins. Among all crypto assets, stablecoins have as a distinctive feature the existence of stabilization mechanisms. And such mechanisms purport to maintain a stable value by pegging the tokens to a real-world asset. So stabilization mechanisms should overcome one of the limits of unbacked crypto assets, that is, their price volatility. Price volatility arises from the lack of a fundamental value associated to the token. And due to price volatility, unbacked crypto assets have mainly been used for speculative purposes. By contrast, stablecoins aim to maintain a stable price through the backing of reserve assets or through algorithms that respond to demand and supply. However, it's worth clarifying already at this stage that according to the FSB high-level recommendations on global stablecoin arrangements that I will discuss later, algorithmic stabilization mechanisms are not sufficiently reliable. For sure, this stance of the IMF is mindful of the failure of Terra USD in May 2022. Stablecoins are generally denominated in a monetary unit of account, such as the dollar, and may pledge to redeem into cash at par. As such, to a certain extent, they can represent an alternative to currency as a store of value and as a means of payment. And as a matter of fact, recent studies find, for instance, that stablecoins are increasingly being adopted in cross-border remittances, as the organizers were reminding at the outset. However, the purported stability of stablecoins is also a potential source of risks. Widespread adoption of stablecoins in a country could threaten the effectiveness of monetary policy in that country. People who choose to receive payments or make transactions in a stablecoin instead of the local currency are in fact rejecting the money printed by their own central bank. And this makes it difficult for central banks to influence their economies through interest rates and other monetary policy tools. The risk of currency substitution, cryptoization, if you will, is particularly strong for countries with unstable currencies and weak monetary frameworks, and with a banking system which is perceived as being untrustworthy or antiquated. In such countries, people can be attracted by stablecoins denominated in foreign currencies, as they could offer a less volatile alternative to the domestic currency. Compared to commercial banks, crypto asset service providers could also offer easier and cheaper solutions for transferring money globally. Moreover, crypto lending platforms promise higher returns than a deposit in a bank, and these also can attract investors to convert traditional currency into stablecoins and park their savings there. Also, compared to reserve currencies like the dollar or the euro, access to stablecoins could be seen by some as smoother or more profitable. Connected to this, the risk of bank disintermediation also arises. A significant shift from bank deposits into stablecoins, or more generally into privately issued digital assets, could have implications for lending and intermediation by the banking sector. If banks were to lose wide amounts of deposits, their ability to channel credit to the real economy would be jeopardized. And this would have a negative impact on financial stability. In this respect, it must also be considered that bank deposits fully benefit from the financial safety net, including from deposit insurance. As long as stablecoins are not insured, their alleged stability alone doesn't make them fully comparable to bank deposits as a store of value. The implications are different. The risks of currency substitution and bank disintermediation are currently addressed by jurisdictions by way of setting volume limits sometimes. These can be fixed in regulation, such as under MiCA, or left to the discretion of the supervisor, such as in Hong Kong. Market risk related to stable coins may affect the stability of financial institutions. To a certain extent, the traditional financial sector is exposed to crypto assets. On the one hand, some financial institutions hold crypto assets and provide credit and financial services to operators, like trading platforms and wallet providers. On the other hand, some financial institutions provide credit and financial services to investors in crypto assets. Altogether, these financial institutions are therefore exposed to sharp declines in crypto asset prices. Mismatch between stable coins and the assets that maintain their peg is a source of liquidity risk as well. Often stablecoin reserves are not fully liquid, but consist of a mix of commercial paper, short-term securities, and cash. And this limits the amount that can be redeemed at par on a short notice. The liquidity mismatch between stablecoins and reserves also gives rise to the risk of runs. As happened with money markets funds in 2008 and 2020, stablecoin issuers could feel the pressure to invest in risky assets and achieve higher returns. Hence, they could deviate from a prudent composition of reserve assets. If investors lose confidence in the value of a stablecoin, they will want to redeem their holdings. If the assets backing the stablecoin cannot be sold quickly, the pressure to redeem the tokens will increase and the run might get worse in a vicious circle. In addition, the sale of reserve assets could put pressure on liquidity in the reserve asset markets, treasuries, commercial paper, and what's not. Not by chance, several jurisdictions already require issuers to maintain reserves of high-quality liquid assets to ensure price stability and protect holders in situations where they wish to redeem their stable coins quickly, such as in a stress scenario. Several vulnerabilities in crypto asset markets increase credit risk. Essentially, they boil down to the opacity of crypto assets. Disclosure and reporting requirements for stablecoin arrangements have long been lacking, not only on their reserve asset composition, but also on governance aspects. Individuals or entities who are responsible for crypto assets operations are often unknown. In other cases, governance is scattered among multiple entities that have control or influence only over certain aspects or activities. This affects lenders' capacity to assess and monitor borrowers' creditworthiness. But it also affects users' ability to understand the risks of participating in crypto assets markets. Excessive leverage in crypto asset markets amplifies credit risk. It weakens borrowers' balance sheet positions and raises counterparty risks. Over-collateralization mechanisms could not be enough to mitigate this risk. Funds borrowed in one instance could be reused as collateral in other transactions. And as a matter of fact, in crypto asset markets, investors have been able to build increasingly large exposures starting from a given amount of collateral. Operational risk arises from technological dependency and blockchain infrastructure. Crypto asset markets in general depend on complex and rapidly evolving technologies. Maintaining and developing such technologies required, in turn, specialized knowledge, and technical and cybersecurity issues might generate losses for market participants. Of course, operational and cyber incidents are relevant for any technological system, but they would become especially pressing for a very widely adopted stablecoin. Now, so far, I have provided an overview of the main risks associated with stablecoin. In the next part of my presentation, I will summarize the steps taken by international standard setters so far to mitigate such risks. Several risks are addressed by the IOSCO guidance on the applications of the principles for financial market infrastructures to stablecoin arrangements of July 2022, by the IMF policy paper of February 2023 on elements of effective policies for crypto assets, by the FSB high-level recommendations of July 2023. These are two distinct sets of recommendations, the first for crypto assets in general and the second for global stablecoin arrangements. In addition to those, in November 2023, an FSB report reflected on the financial stability implications of multifunction crypto assets intermediaries, based on the assumption that the combination of functions on a single player in this sector may concentrate and amplify risks and may pose challenges in terms of conflicts of interest. And this is especially the case considering that in certain jurisdictions, crypto asset service providers, due to lack of regulation, are allowed to combine functions that cannot be combined in traditional finance. In terms of method, all said documents conform to the same principle, to one principle, same activity, same risk, same regulation. Where crypto assets and intermediary perform an equivalent economic function to one performed by instruments and intermediaries of the traditional financial sector, they should be subject to equivalent regulation. This principle is particularly useful to introduce the first of the documents I have just mentioned, that is the IOSCO guidance on the application of the principles for FMIs to stablecoin arrangements. The guidance recognizes that stablecoin arrangements can perform an equivalent function to financial market infrastructures in cases where they are primarily used for making payments. Stablecoins' usability as a means of payment relies on the transfer function of a stablecoin arrangement. Stablecoins arrangements enable the transfer of coins between users, and this typically happens through the operation of a system, a set of rules for the transfer of coins among participants, and a mechanism for validating transactions. So the transfer function of a stablecoin arrangement is comparable to the transfer function performed by other types of FMIs. As a result, a stablecoin arrangement that performs this transfer function is considered an FMI for the purpose of the application of the principles, if it is systemically important, of course. Incidentally, the guidance, among other things, also offers elements for the assessment of the systemic importance of a stablecoin arrangement. However, stablecoin arrangements present distinctive features as compared with traditional financial market infrastructures, and these features pose new challenges, specific challenges. This is why the guidance provides directions on the specific principles connected to such features and challenges. As for governance, IOSCO principles in general outline the expectation that an FMI should have documented and disclosed governance arrangements with clear and direct lines of responsibility and accountability. Such arrangements should also specify the roles and responsibility of the board of directors and management. A first issue arises with reference to stablecoin arrangements governance that is partially or fully decentralized. In cases where no legal entities or persons are in control of the FMI function. In particular, the transfer function within the stablecoin arrangement can be set up as a smart contract on a permissionless ledger, and it can be performed solely by software without a human in the loop. In this respect, the guidance aims at avoiding situations where there is no entity or person responsible or accountable for the performance of the transfer functions. Stablecoin arrangements are expected to make sure that there are identifiable natural persons at the top of the chain of control who are in charge and will ultimately bear responsibility and be accountable for the operations. A second issue concerns flexibility in decision making. Governance implemented only by software can turn out to be inflexible. As such, it could not be suitable for a changing environment and could be unable to deal with unforeseen situations. Such situations sometimes require expert judgment and discretionary decision making. In this respect, the guidance calls for the possibility of timely human intervention. Similar expectations on governance of stablecoin arrangements are set out by the Financial Stability Board in its fourth high-level recommendation on global stablecoin arrangements, also beyond their transfer function. As for risk management, IOSCO principles expect FMIs to have a framework in place for the comprehensive and effective management of risks. In this regard, an issue arises as stablecoin arrangements fulfill multiple interdependent functions in addition to the transfer function. Some of these additional functions are not under the umbrella of the FMI function, and as such, they're out of the scope of application of the IOSCO principles. For instance, think of the issuance, redemption, and value stabilization functions. They are not typical of payment systems. Now, while such functions could be operated by independent entities, they still have risk implications, legal, credit, liquidity, risk implication on the transfer functions, and the other way around. Therefore, the guidance expects stablecoin arrangements to develop integrated and comprehensive view also of the risks to the FMI function arising from the other functions, and to introduce measures to mitigate such risks. Again, similar expectations on risk management frameworks have been laid down by the FSB in its fifth recommendation on global stablecoin arrangements. Stablecoin arrangements are therefore expected to comprehensively address all material risks associated with all their functions and activities, also beyond their transfer function. One more key element in the IOSCO principles for FMIs is the required clarity and certainty of the settlement finality, which is critical to mitigating systemic risk. Now, in certain stablecoin arrangements models, the finality of the transaction relies on types of consensus where the algorithm is probabilistic. So the probabilistic finality doesn't allow the determination of the precise moment of operational finality. Under these models, the validation of a transaction on a ledger can never be achieved with absolute certainty. It only increases as more transactions are added onto the ledger. And in some instances, even forks may occur, disagreements between nodes leading to bifurcations in the development of the ledger. In this respect, the guidance expects stablecoin arrangements to clearly define the point at which a transfer is irrevocable and unconditional, to make sure that a clear legal basis supports the finality of the settlement, and to prevent or neutralize competing states of the ledger that could affect the settlement finality. Finally, one last issue arises with reference to money settlements, in respect of Principle 9, that is, the principle setting the expectation that an FMI should conduct its money settlement in central bank money where practical and available, or otherwise use a settlement asset with little or no credit and liquidity risk. Now, in stablecoin arrangements, a stablecoin is used as the settlement asset. Therefore, participants will be subject to the credit and liquidity risks of the stablecoin itself, of the issuer of the stablecoin, and or of the settlement institution if different. This may result in a greater amount of risk than little to no credit and liquidity risk, and may not enable the FMI and its participants to readily transfer their assets into other liquid assets, such as claims on a central bank. To tackle such concerns, the guidance expects a stablecoin arrangement to make sure that the credit and liquidity risks of the stablecoin that it uses for money settlements are minimized and strictly controlled. To this end, stablecoin arrangements should make sure that the stablecoin is an acceptable alternative to the use of central bank money, based on several elements listed in the guidance. And now we are going back to what I was saying at the beginning, because these elements include the clarity and enforceability of the legal rights accorded to holders of the stablecoin and stablecoin arrangement participants vis-à-vis the issuer, also with reference with the reserve assets and in the context of insolvency. Remember the nature of the right. The insolvency of the issuer, of the reserve manager, of the custodian. The nature and sufficiency of the stablecoin arrangement reserve assets, and the clarity, robustness, and timeliness of the process for converting the stablecoins into other liquid assets. Now, this is all with reference to the OSCO guidance, and it's already a lot, I know. Of course, as I already said, stablecoin arrangements are also subject to FSB recommendations that set out more general expectations. These include appropriate regulatory and supervisory frameworks being in place, with public authorities having adequate legal power and financial resources to pursue their mandates, and the timely drafting of appropriate recovery and resolution plans, allowing the orderly winding up of stablecoin arrangements as need be. Among FSB recommendations, it's worth mentioning those on disclosure requirements and redemption right and stabilization mechanism. They are of paramount importance from two different perspectives, that is, consumer protection and financial stability. In fact, the reliability of the stability commitment of a stablecoin arrangement at the end of the day will depend on the reserves backing the coins. Therefore, stablecoin arrangements are expected to hold reserves that, based on their amount, quality, and composition, can actually allow for the timely conversion of the coins into cash. In turn, custodial arrangements for reserve assets should ensure safe custody, proper record keeping, and segregation, shielding the assets from claims of the creditors of the issuer, of the stablecoin's issuer. At the same time, to mitigate run risk, redemption claims should be based on solid legal grounds and should be processed without undue costs and undue delays. For these arrangements to be effective, authorities will have to require stablecoin arrangements to disclose in advance to the general public all the necessary information to understand the functioning of the stablecoin arrangement. In conclusion, as stablecoins use as a means of payment and store of value has grown, several elements of the financial safety net are in the process of being extended to stablecoin arrangements. Licensing requirements, prudential and conduct of business rules, supervisory powers, resolution regimes. This process, at the end of the day, should lead to mitigating risks and allowing stablecoins to coexist with the two-tier monetary system. However, structural features exist that separate and will separate stablecoins from fiat money. Stablecoins are digital claims against private issuers, and as such, they are not backed by a promise of the state. They circulate as bearer instruments, and they are traded on secondary markets. As such, stablecoins have a prevailing market price and an exchange rate that fluctuates away from par. Both values reflect, at the end of the day, the credibility of the issuer-specific promise to redeem the coins for cash. Finally, stablecoins only settle in central bank money when tokens are redeemed for cash or conventional deposit, in which case they are deleted or burned. All in all, stablecoins display a structural and inevitable otherness to fiat money. In many ways, this is a potential source of friction in the convertibility of stablecoins into other forms of money. These frictions cannot be eliminated for good and can provide the case for further elaboration of dedicated rules on stablecoins. Thank you.
Thank you very much, Donato, for your insightful presentation, and you have shed light on the risks that stablecoins pose for the financial stability and the recommendations of the international standard setters. Now we give the floor to my colleague, Alexis Direr, who is Professor of Economics at the University of Orléans. Alexis is going to talk about the role of stablecoins, and as an economist, he's going to give us some data. So, thank you.
Thank you, Anastasia. So when we constructed the program, we were not sure that everybody in the audience were up to date with the basic facts about stablecoins. So we decided to include a short presentation of the current situation of stablecoin market. So this is the modest objective of this presentation. So I have 10 minutes in the program, so it will be relatively short. Let's begin by some facts. The first fact is that if stablecoins were one single aggregated cryptocurrency, it will be the third one in terms of market capitalization. So we can see with this aggregate view that stablecoins are already a very important crypto asset alongside Bitcoin and Ether. The second fact is that we are witnessing a very important growth rate of stablecoin market cap, especially since late 23, with a very high growth without a sign of slowing down. And this is why we can predict, it's not unreasonable, that the total value could surpass $1 trillion possibly at the end of the decade. So it is already a very big market, but expectations are very optimistic about the future of this kind of market. A third fact is that the market is very concentrated among a limited set of actors. Tether is the leading providers of stablecoin historically and presently, with 62% of market share. And behind Tether, there is Circle, which, contrary to Tether, which is unregulated and offshore, Circle is a US-based regulated provider. And the two make up nearly 90% of the market. So it is a very concentrated market because they were early actor in the market, so they benefited from network effects a lot. The last fact is that the current situation is dominated largely by dollar stablecoin. If we compare dollar stablecoins and euro stablecoins, there is a very huge gap between the two. The market cap, total market cap of euro stablecoins is nearly $500 million compared to $235 billion for dollar stablecoin. So the euro market is lagging by a large margin, and it's also noteworthy that the first provider of euro stablecoin is Circle, which is a US-based company. So yeah, the comparison between the two markets is very stark. Now, if we go back to why stablecoins are a success and are largely adopted worldwide, we can see that there are several utilities of holding stablecoins. First, transfers of stablecoin are highly efficient today. You can have quasi-instant transfer, 24/7, borderless transfers. And also today, you can transfer large amount of stablecoins with fees below 1 cent, not in all blockchains, but in blockchains like Base or Tron, for example. Also, this cryptocurrency is generally pegged to the dollar, so it's not volatile compared to other cryptocurrencies. So it is a better store of value than many other cryptocurrencies. You can hold dollars worldwide without having to open US bank accounts. So it's be very practical. Because it circulates on the blockchain, there is much less intermediaries in the process, so the fees are much less, and operations are handled by smart contract, and so it is also to some extent efficient in terms of fees. So those utilities open up multiple use cases for stablecoins. The first one is stablecoins are seen as a store of value by many users in the world, especially in mid-income countries where inflation can be very high. Also payment for transborder payments like remittances. Businesses and users underserved by bank and fintechs can manage their cash with stablecoins. This is also used for price speculations and in France, the deferral of capital gain taxation. And on top of that, if you have stablecoins, you can get a yield, either in centralized exchanges or in decentralized finance, which can be quite interesting. So how do stablecoin providers operate behind the scene? Let's take the example on the left of Circle. Circle has a very simple balance sheet because the mechanism is relatively simple. Every time a Circle mints one token, it invests $1 in financial markets, in liquid short-term debt, usually US T-bills, and a fraction of the reserve is deposited in banks for easing redemptions. And presently, the fraction is 14%, which is anecdotally much less than what is required by MiCA, for example. And compared to a bank's balance sheet, it is much more simple, to some extent much more safer, because providers do not transform risk, do not transform maturity, so there are no such risk in this type of business. So this deserves to this regard a more light regulation, I think. Given that, we can see that stablecoins can be a very profitable business. For instance, if we compare Tether and BlackRock in 2024, Tether had a net profit higher than BlackRock, despite having much less employees, 100. And why is that? Because you can think of Tether or even Circle as a big money market fund, with the exception that the yield from the money market is not distributed to the end users, but kept by the provider. So you can imagine that, at the end of the day, the profit can be very huge. Given that this activity can be very profitable, it is no wonder that many institutions are entering the market. So we assist currently to a second phase of the development of stablecoins market, because all those fintechs, banks, or asset managers brings or will bring millions of users to the opportunity to hold stablecoins in the future. They are currently Robinhood, PayPal, BlackRock. Stripe has acquired the startup Bridge Payment, Société Générale with its subsidiary Forge. Fidelity has announced a stablecoin, and the Bank of America has also announced that if lawmakers pass legislation, the second largest bank in United States would enter the market. So the market is really entering into a new phase, a new dimension presently. And to finish this short presentation, I would like to outline that stablecoins are not only a financial innovation, but also can be a geopolitical instrument. I will quote Scott Bessent, who is the US Secretary of Treasury. We are going to keep the US the dominant reserve currency in the world, and we will use stablecoin to do that. And this contrast with the recent quote of Pierre Gramigna, head of the European Stability Mechanism. If plans by the US administration to launch massive payment solutions based on dollar-pegged stablecoins were to succeed, it could affect the monetary sovereignty and financial stability of the Eurozone. It is urgent that the ECB makes the digital euro a reality to safeguard Europe's strategic autonomy. So we can see that not only stablecoins are promised to fast development, but also could become a weapon in the broader battleground of monetary policy across the world. And I will end on these quotes.
Thank you very much, Alexis, for your insightful thoughts on the utility of stablecoins. I'm going to present the MiCA regulation. I'm going to give first a general overview of this regulation and then a critical assessment. So, as you all know, MiCA regulation, which is the applicable legal framework in Europe for crypto assets and stablecoins, is the most far-reaching and thorough regulatory approach to crypto assets globally. However, Europe is not currently home to the largest players in the crypto industry. So the market dominance and the value is largely concentrated in the US and in Asia. So if, for example, we look at the 2024 Global Crypto Adoption Index, which is published by Chain Analysis, no EU member state ranks among the 20 top countries. So this leads us to the following question. Why did the European Union legislator decided to adopt such a comprehensive regulatory framework? The main reason lies on the famous Libra project, which was launched in June 2019 by Facebook from Geneva with the aim to create a global stablecoin backed by a basket of official currencies and low-risk assets. And the announcement of this Libra project faced with significant backlash from European and national policymakers who competed one another to be the strongest opponent to the concept of a global digital private money. But this was not the only reason. The absence of an applicable European framework, the regulatory fragmentation in Europe, with some countries like France that had adopted a national legislation, the Law Pact, and also the EU's ambition to be the leader in the tech regulation. All these reasons urged the European Union to act, and to act quickly and decisively. So this was the origin of MiCA. Now, which are the objectives that MiCA regulation pursues? So MiCA actually aims to protect investors that use buy crypto assets and use crypto asset services. It also aims to preserve financial stability and the smooth functioning of payment systems and also of the monetary policy. It also aims to avoid regulatory fragmentation and to allow companies to engage in tokens issuance and services on the basis of a single license and not 27 separate licenses and 27 separate supervisors. And also it aims to provide a clear rule book and therefore providing legal security and ensuring fair competition and fostering innovation. Now, what does MiCA actually do? First, it introduces a taxonomy of crypto assets, and it also imposes requirements on crypto assets issuers and service providers, but I will focus on the requirements imposed on stablecoin issuers. So which is the taxonomy that MiCA introduces? It distinguishes between asset reference tokens, e-money tokens, and other tokens. Asset reference tokens and e-money tokens both are types of stablecoins, but they differ in the way that they try to stabilize the value of the stablecoin. The asset reference tokens aim to stabilize the value by referencing to a basket of assets, which may be composed by financial instruments, cryptocurrencies, official currencies, commodities, or by referencing to a single asset, but this single asset should not be an official currency of a state. By contrast, e-money tokens try to stabilize their value by referencing to an official currency, and this is euro or the US dollar. And this concept of e-money tokens stems from a concept that we know in Europe, the concept of e-money, which is regulated, and the requirements also of MiCA stem from the regulation of e-money. Now, having said that, which are the requirements that are imposed on the issuers of stablecoins? I will start with the issuers of asset reference tokens. So, issuers of asset reference tokens need to be authorized from their home member state, and they also need to publish a white paper that needs to be approved by the national competent authority. Furthermore, they need to meet own fund requirements, and also they need to meet certain reserve management standards related to custody, segregation, investment policy of the assets, etc. And they are obliged to redeem the holders of the asset reference tokens at any time and at their request, and they are prohibited from granting interest to their holders. Now, what about issuers of e-money tokens? Issuers of e-money tokens need to be regulated credit institutions or e-money institutions. So only these entities can issue e-money tokens. And unlike issuers of asset reference tokens, they don't need to get their white paper approved by the competent authority. They only need to notify their white paper. Furthermore, they need to meet own fund requirements and also asset management requirements that they are similar to the requirements imposed on the issuers of asset reference tokens. They also need to redeem the holders. They are prohibited from granting interests as well. But unlike issuers of asset reference tokens, issuers of e-money tokens need to hold 30% of the funds that they receive in exchange of the e-money tokens they issue in separate accounts held in credit institutions. But MiCA introduces also another notion, the notion of significant stablecoins, significant asset reference tokens or e-money tokens. So these are stablecoins that exceed certain thresholds and related to market value or the volume of transactions, but we're going to talk about these thresholds. And if these thresholds are met, the issuers of these significant stablecoins need to comply with higher prudential, governance, and liquidity requirements. And most importantly, they need to be supervised, they're supervised by the European Banking Authority. But this does not end here. MiCA introduces also another layer on the stablecoins hierarchy, which we could call super significant. These are asset reference tokens or e-money tokens that they are referenced. They're referencing an official currency of a non-EU member state. If these tokens reach certain thresholds, for example, more than 1 million transactions per day, or if their value is over 200 million euros per day, calculated over a period of 3 months, then their issuers are prohibited from making new issuances, so they should stop issuing their stablecoins. And furthermore, they should submit a plan to the competent authority on how they could reduce their usage in order not to exceed these thresholds. So this is the reason is to protect actually the euro and the official currencies of the member states as a means of payment. Having said that, what could we think about MiCA regulation? This is my personal view. So it seems to me that MiCA tries to pursue some conflicting policies relating to stablecoins. Because on the one hand, it enhances their adoption by providing a clear legal framework, but on the other hand, it prevents their widespread use. So we could understand this conflicting policy. We think about the objectives of MiCA, which are investor protection on the one hand, and monetary policy and on the other hand. But before the rise of the stablecoins, these objectives were pursued in different areas of law, so financial markets law and monetary and payment services law. But here we have a single instrument, MiCA, that combines everything, and I think there are some conflicting issues that could create some uncertainties. I will give you an example. Let's think about a stablecoin from its issuance to reaching the status of super significant. So we could say that MiCA enhances its adoption by providing strong investor protections, But when the stablecoin reaches certain thresholds, then the issuer, the MiCA, bans its issuance, and even obliges the issuer to submit a plan to reduce its use. So how will the market react to this back and forth? I think this creates significant uncertainties for issuers. Furthermore, I think that MiCA creates significant privileges for the traditional financial industry. For example, if you are a credit institution and you want to issue asset reference tokens, you don't need any authorization. In addition, MiCA creates significant, and this is my view, barriers to issuers from third countries, because if you are an issuer from established outside the Europe and you want to offer your stablecoins in the European Union, you need to create a separate legal entity in one of the 27 member states and meet MiCA requirements. So there's no deviation from this rule, even if you are highly regulated and supervised in your home country. And unlike traditional financial regulation, MiCA does not provide for the recognition of equivalence regimes, which is quite unique. So I think that MiCA actually is open to stablecoin issuances, but only if they comply with the EU rules, only if they are based in the European Union, and only if they respect the predefined limits that it sets. So will MiCA become the leader regulation in stablecoins? I'm not sure, and I'm not sure if Europe will become the leading industry. So this is one of the points that we're going to discuss over a roundtable. We have distinguished experts that represent all voices from industry, the regulators, and also lawyers. So I invite you to join us, Stéphanie, Louis, Mathieu, and Hubert. Okay. So I will first present our distinguished panelists. I will start with Luis Del Olmo. Luis Del Olmo is an economist and insurance actuary. He's a senior expert at the European Banking Authority, and previously he had held positions at the Bank of Spain, and he was also a professor of finance at the University Complutense of Madrid. Then Mathieu Villaine, who works in the fintech hub of the French regulator, the ACPR. So he's in contact with projects, with fintech projects, and stablecoins issuers, perhaps. And he has followed the MiCA, the adoption of the MiCA regulation. So some voices from the industry. Stéphanie Cabot-Sioras, who has actively engaged in the development of the crypto asset environment in France. She's currently a general secretary at the Société Générale Force, who is a stablecoin issuer. And previously, she was the managing director of Binance France, and she has also held important positions at all French authorities, AMF, Bank of France, and yes. So another voice from the industry, Pierre Persson, who is CEO of Usual, and that engages with the development of stablecoins. And Pierre was a former member of the French Parliament, and I think that he has engaged in the adoption of the national legal framework of the law pact. And finally, we have with us one of the most prominent legal experts in France on crypto assets, fintech, and banking and financial regulation, Hubert de Vauplan, who is partner at Morgan Lewis, and he has participated in in all financial market law committees. And he currently consults fintech and fintech firms. So thank you all for being here today. I will start the discussion with we'll start with the regulators and Louis and Mathieu. So I think I will start with the European Banking Authority. So Louis, can you explain the role of EBA in the implementation and enforcement of MiCA regulation?
So thank you. Good afternoon, everybody. Thanks for the invite. It's a pleasure to be here. Indeed, I try to a little bit explain what we have been doing on this field at the EBA from different angles during these last years and what comes afterwards. So you may remember once MiCA is there, is published, the EBA, as traditionally happens also with the banking activities, receives a number of mandates, and our first role was precisely from a regulatory point of view to elaborate, develop a little bit the level 1 text MiCA through a set of different type of technical standards, guidelines, and so on. Around more than 20 standards have been published, thank you, by the EBA so far. Hopefully they will be approved little by little by the Commission and implemented quickly. So the range of type of standards is very wide, as you may have seen. I can share with the industry the complexity of the issue and the effort and the analysis of also many rules now, but it's a new business activity, and this requires, of course, a good regulation. This, as I said, ranges basically from different aspects: authorization, governance, and mainly importantly prudential requirements, as was said before here, covering basically own funds requirements, reserve requirements, liquidity management requirements, and in addition to that, and also very importantly, all the reporting requirements that are necessary to be able to develop, manage, and supervise these activities. In addition to that, also from a regulatory point of view, you may be aware, if you are more or less familiar with the ABA, we have a Q&A tool where everybody is basically invited to be able to raise their questions and get answers from EBA. The second step from our side is now more from a supervisory point of view. The EBA receives some mandates also in terms of supervision. And in this regard, our first role at this stage is basically to try to cooperate and coordinate work on supervision with competent authorities. So in the beginning, as was explained, when the tokens arise and are considered as non-significant, supervision corresponds to the relevant authority. But this is a new business, this is a new activity, and requires a lot of joint efforts, a lot of discussions, a lot of analysis. And what the ABA was mandated and did was to set up a standing committee, which is called Crypto Asset Standing Committee, that is regularly meeting with all the competent authorities, the European Commission, the different agencies, ESMA, the central bank, in order to ensure that there is let's say, a minimum convergence, harmonized approach from a supervisory point of view, so that minimum level playing field is ensured and that there are not, let's say, divergences across the different competent authorities, that the different, let's say, the various tokens are assessed similarly, that the same type of risk profile of tokens across different competent authorities might be treated similarly, and that does not create, let's say, privileges or disadvantages in seeking authorization in one or another member state and are differently treated. So this is the main important point that now, from a supervisory point of view, the ABA is developing. And other stories, as was said, there might be a direct supervision role whenever there are significant tokens in place. The ABA, in addition to this, is mandated to let's say, elaborate in parallel tasks. One of them is about classification of the tokens, either ARTs or e-money tokens. And this is something that can be requested by competent authorities, simply to clarify which is the type of, basically, mechanism of stabilization that is expected behind, reunits the minimum conditions as ART or e-money token, is a, let's say, a consultative role that the ABA develops here. So it basically culminates with the issuance of, let's say, non-binding opinions for the relevant authority, normally in the process of the authorization. Because it makes a lot of difference, of course, from a regulatory point of view, whether the final token, the final crypto asset, is classified as an asset reference token or as an e-money token. And in addition to this, the ABA will also need to run regularly significance assessments on a yearly basis. This will be the first year, of course, to do it. We will talk about this a bit later, I understand. So then I will not try to anticipate too much on this. So basically, I would say that this is the most important steps that we are taking at the moment from the perspective of implementing the regulation. The regulatory part, let's say, is basically to a great extent done at the moment. It's a first step. Of course, as we said, this is just the start of these activities in the EU. At a point in time, there might be a need to review regulations, but hopefully not very soon. And we can give time to the industry, to participants, to stabilize with the rules in place, assess its application, and whenever, if it's needed, so proceed to any adaptation of them. So basically, this is what I might, inform.
Thank you very much, Luis. And Mathieu, which is your experience as a national supervisor?
Yes, thank you very much, and good afternoon. So I will start with a general comment on MiCA. Then I will share with you some initial feedback on the different stablecoin issuers supervised at the ACPR. So as a general comment, I can say that ACPR supported the elaboration of MiCA because there was a real lack. So now we have one of the first comprehensive legal framework in the world for crypto assets. We were in favor of the application of a rule based on the EMD2 for stablecoin issuer and aligned with the FSB recommendation also. I would say that MiCA more or less addressed the main concern of the ACPR. Obviously, there are provisions to protect the financial stability, but also we have provision to protect the user with the redemption right, also the white paper and the management of the reserve, rule on the protection of funds. And we think also, we believe that MiCA can promote innovation by fostering an orderly development of crypto assets. We think that the fact that issuer has been authorized is can reassure their potential partner, including bank and also, of course, the user. So Now, concerning the first piece of feedback I can share with you, you will see that many of my comments concern EMT, electronic money token, because at CPR we authorize 2 issuers of electronic money token. We have some projects for the issuance of asset reference token, but at this stage they are less mature. And I think this is a finding shared at the European level. So we have a contact point at the ACPR for stablecoin issuer project where we assess the planned activity. We try to identify, to understand the project, of course, and to qualify the token, to identify the regulation applicable. As this is a new activity, of course, some projects raise some difficulties. When this is the case, we can coordinate our interpretation with other competent national authority through the European Supervisory Authority, of course, with, for example, the guideline on the classification of crypto asset, or the Q&A tool of the EBA or the ESMA. And we have also a sort of internal task force to discuss classification of crypto asset. So I would say that one of the main issues for an authority such as the ACPR is to be sure that when a crypto asset is qualified as a stablecoin, is really stable, in fact. I mean that the promise made to the user on the stability of the value will be kept, and that for the redemption, and I add for the redemption at a pair value. This is very important. One other issue for us is the double status. A lot of issuers have several activities, and we have to assess if they need to have another authorization. When this is the case, we have to discuss with, for example, our colleague of the AMF to discuss how to apply the prudential requirements. Now, some piece of feedback on the difficulties that the issuer can face. There are difficulties concerning anti-money laundering, concerning the protection of funds, the amount of own fund, and also for the business model. So concerning anti-money laundering, obviously they have to apply the anti-money laundering framework, even if in the field of crypto asset it is not easy in practice sometimes, but they have to apply KYC measure to identify their direct client and direct client who acquires their stablecoin or who distribute the stablecoin they have issued. And also they have to be able to track the transaction made on the blockchain with their stablecoin in order to identify potential illicit transaction. For that, they can use solutions provided by OAT, the blockchain analytic tools. Concerning the protection of funds under Article 54 of MiCA, issuers of stablecoin have to protect the fund collected. For that, they have to find a bank to deposit the client fund on a dedicated account. For now, it seems that they do not face too major difficulty to find a bank, but that could change in the future if, for example, the size of the issuance become larger or significant under MiCA, or if IRT issuers are authorized. In that cases, they will have to find several banking partners, and that could be difficult. And concerning the business model, as you know, in the payment sector, most of the revenue come from the interest earned on the fund collected. And if in the future the interest rate situation change, that can be a difficulty for them, and they will have to find maybe new source of revenue. And in fact, that can be a challenge for them. Thank you.
Thank you, Mathieu, for your insights. So, Stephanie, yes, could you please tell us which are the main business challenges in complying with MiCA? So, what are the concerns of stablecoin issuers?
Yeah, alors first, before concerns, explain a bit how we are regulated. So Société Générale Forge is one of the first issuers of a euro stablecoin in Europe, and we were one of the first to be regulated under MiCA, under the ACPR supervision. We got this license in last July, so almost the first day of entry into application of MiCA. Alors, what is this stablecoin? So it's quite common. It's a crypto asset issued with a stable parity with the euro only. The specificity of this stablecoin is that the reserve account, so all the reserve of the stablecoin, is held 100% in cash. So we have not applied the possibility to diversify the reserve. And this cash account is held at Société Générale Group, so under a tier 1 bank. So far, to my knowledge, it's the first and the only stablecoin issued by a banking entity and with the very limited counterparty risk because of the reserve account is at a tier 1 bank. So was it difficult to apply MiCA? Honestly, for a banking subsidiary, it's normal practices. Société Générale Forge has also other licenses, investment firm license, VASP license, agrément PSAN, and all the controls and regulatory environment with MiCA is quite similar to traditional finance in terms of governance, of controls, of cybersecurity, of financial, management of flows, etc. So it's not easy, but it's banking grade expectations. What is more difficult is for crypto natives, for entities which are not coming from traditional finance. I'm speaking here with a little bit with my hat of member of the board of ADAN, which is the Crypto Asset Professional Association. For new players, there is really a question of maturity about MiCA, because all of these new players need to upgrade their level of regulatory maturity to the level of traditional finance. So it's a bit difficult. However, MiCA is really a good news for the ecosystem and for the emergence of the stablecoin, because it creates regulatory clarity around these assets, around the issuance of the asset, and also around the services provided around these assets. So custody, exchange, execution, RTO, etc. So this helps, and this will help traditional finance to adopt these new assets, and for the stablecoin issuers to develop services in the banking and traditional financial industry. For example, for us, maybe two examples. The stablecoin is used primarily for crypto trading. So this is really a use case dedicated to crypto. So we have partners, crypto exchanges or crypto brokers, for example, Bitstamp or Bitpanda. And we have also crypto market makers, crypto liquidity providers, distributing the coin in this environment. And we are working also on two other use cases. First, the payment industry, to integrate the stablecoin as a payment asset in all payment industry. So we are working with a payment services provider, and it's only possible because the issuance and the management of the asset is regulated. If we were to develop payment services with an unregulated asset, but of course, it won't be inside the bank, but even for payment services provider, it will be difficult to offer it. And for merchants and end users, it would be also very difficult to adopt because the quality of the asset would be questionable. The other use case I have in mind is a wholesale settlement of transactions. stable coins can become one settlement asset for financial transactions. So, for example, with Société Générale Forge, we have done the first transaction of settlement of a tokenized bond in stablecoin. So it means that we have issued a bond on the blockchain, and then this bond was settled, was bought with our stablecoin. So we were able to tokenize on the blockchain the whole transaction, the securities leg and the cash leg. Already now there are market infrastructures in Germany, unfortunately, under the pilot regime, who have developed market trading venue, secondary market of tokenized bonds, of tokenized assets, and the settlement asset is stablecoins. Voilà. So this is kind of things that are able to develop with a MiCA regulation. Maybe last point on the concerns. So for me, MiCA is really comprehensible, and it's really broad. Everything is covered. There may be 2 points that are problematic. The first point is that MiCA forbids the distribution of interest on stablecoin. So issuers of stablecoin are forbidden to distribute the interest generated by the reserve. And crypto asset service providers, so exchanges, brokers, are also forbidden to distribute this interest to holders. So this creates major problems. First, a competitiveness problem for all EU actors, because this is not at all market practice. The world market practice is that all stablecoins outside the EU distribute the yield, because this yield is not monetary creation. This yield is generated by the reserve. When you give €1 of stablecoin, you get €1 of fiat money. This fiat money is in a reserve account, either in cash or in liquid asset. And the yield is generated by this reserve. Everywhere else in the world, this yield is redistributed to the final holder of the stablecoin, except in Europe. So we have here a big competitiveness problem for EU players. The second problem is a problem of investor protection, because basically, it's almost political. We say to investors, people who are saving money in the EU, end users, that they are not allowed to get the money generated by their assets. And basically, MiCA is confiscated this money, this yield, to the profit of financial intermediary. So I expect that in the medium term, when this will, people will really understand what's going on, it's a major investor protection problem. Voilà. So for me, if there is one point to modify on MiCA, it's only this, because we are not at all at the level of market practice. The second problem is not really about MiCA, it's more about AML and the application of anti-money laundering rules to DeFi. Because stablecoins are widely used in DeFi, in decentralized finance, decentralized protocols, which are basically financial institutions with nobody behind. They are protocols created to operate financial transactions automatically. Stablecoins are a core asset in this world because they are a settlement asset. And MiCA says that DeFi is not covered by the obligation. So MiCA DeFi protocols can provide crypto asset services without being licensed. However, the AML regulations do not specify how they apply to this environment. So far there is uncertainty, and by uncertainty, normally AML should apply, meaning KYC, meaning transaction monitoring, etc., which is not possible. So for EU players, the development of stablecoins into DeFi is a major problem, and AML regulations should be amended to precise that.
Thank you, Stephanie, and thank you for highlighting the problems with MiCA. So let's turn to significant stablecoins. Luis, perhaps can you talk about the thresholds, the additional requirements for issuers, and if we have a significant stablecoin issuer in Europe?
Yeah, thank you. So yeah, as I was saying, this is the first year that we need to run, and the significance assessment in theory is an annual exercise that we'll need to do it. This year is particularly special because it's the first year that the rules enter into place, and for sure for the final assessment, the official reporting data needs to be available. There's, as you may know, some special timeline for this exercise, and therefore the exercise will run a bit later than expected. I think that the concept of significance at the end of the day in MiCA is trying to reflect how impactful a stablecoin, an token or an ART can be in the financial system in general terms. Well, this is an aspect that has been very much been on top of the table since the beginning of MiCA, because of the requirements that MiCA envisages, the high amounts of deposits that need to be placed with credit institutions in the EU. Mandatory deposits trigger significant concerns for the regulator, and this is an aspect that at the end of the day is considered as an important aspect. One of the criteria indeed to assess, there are 7 criteria in the regulation to assess. One of the criteria is the highly interconnectedness with the financial system. It's a qualitative criteria, and to some extent the Commission intended to try to provide some clarification or some help to assess via delegated regulation and refer there to some potential factors that one might look at. And basically the idea is to assess how much the token might impact the financial system, but also vice versa, how much the financial system might also impact the stablecoin. And therefore, the idea is to look at the type of investments that issuers of tokens do to try to understand how much they are concentrated, how much they are impacting into the provision of these financial instruments in the market. And on the other hand, the other way around, of course, is also to understand somehow how much the financial instruments they might invest in can impact the stablecoin. Another important aspect, another criteria is related to the international scale of the token, right? Because obviously it's also about how much impact it might trigger in the general EU economy. And there also the Commission provided in this delegated regulation some ideas of how this could be looked at. Basically, paying attention to the market capitalization, the relative market capitalization that the token at a global level might have, or at the amounts of the cross-border transactions that this token might be used. Again, this is a kind of a qualitative criteria. These 2 are the most qualitative ones, for which there's no specific threshold, so there's a need for some type of, let's say, assessment. Others are like more quantitative defined, and here the regulator refers to some minimum amounts of the number of holders, the volume of the transactions, the number of the transactions. They also refer basically to whether the institution, the issuer, also provides other type of crypto services or issues more than one token. So these are a little bit more objective, let's say, to some extent, but they're also a combination of qualitative and quantitative criteria. So this will be an exercise, as I said, that needs to be run. The consequences or the implications that for a token to be classified as significant is very much linked to the requirements, because indeed this is the logical consequence, right? If it has expectedly a more impact on the general financial system, in principle should be better covered or more strictly covered, let's say. And therefore, for significant tokens, there are specific requirements in the regulation. basically related to liquidity, the need to ensure resilient reserve of assets, as was mentioned, to ensure the stabilization of the value, a proper liquidity management of the reserves, basically. Very importantly, the need to run liquidity stress tests. This is a very important item as well, because indeed the regulation refers to the stability under stress. And also own funds requirements, because it's also about the solvency of the institution. So there are implications from a prudential perspective that are very much straightforward to find in the regulation in MiCA and developed via regulatory technical standards. When a token is considered as significant, then there's also a transfer of supervisory powers to the European Banking Authority, depending on the type of token, of one kind or of another type of kind of powers. And if a token is also considered significant, then the next step is also to set up a supervisory college, which is basically a consultative, let's say, forum composed by the relevant authorities, central banks, etc., in order to a little bit play the role as traditional banking of the colleges of supervisors. So basically, this could be a summary of what a significant assessment means in practice and what is the expected implications. Thank you very much.
Thank you, Luis. So let's jump to another topic, the interaction of MiCA with other regulations, and especially the Payment Services 2 Directive. So, Wiber, what do you think? How does MiCA interact with this directive? If we transfer e-money tokens, is this considered as a transfer of funds? Therefore, we apply Payment Services 2 Directive?
This is a good example of what we, as a mistake, if I may. Because it is an unexpected issue which has not been discussed during the MiCA discussion, if I may, and this is due to the legal qualification. It is due to political decision by the EU Commission, but with the support of the ECB, of course, to consider electronic money token, which are defined, by the way, as a crypto assets, in the same time to be considered as electronic money. More specifically, it says, MiCA says, e-money token shall be deemed to be electronic money. In this sense, EMT, electronic money token, falls within the definition of funds. It was unexpected because nobody discussed this topic. And it is due to the importance of the legal qualification. If we consider that EMT are crypto, there is no issue. And again, electronic money token is part of the definition of a crypto. It is a crypto asset. We have various types of crypto assets in the MiCA, and EMT is part of the definition, but this sentence has been added specifically to consider as a hybrid definition, both as crypto and electronic money. When something is hybrid, per definition, it is complex. And if I may, per definition, there is a lot of issues and potentially it doesn't work. What does it mean in practice? It means that there is dual nature of EMT, dual regulation, both as a crypto asset under MiCA and as electronic money under Payment Service Directive. And it creates, of course, complexity for CASP, crypto asset service providers, offering services involving EMTs, which is the case for all of us and all of them. When a CASP provides service relating to EMTs that correspond to the definition of a payment service under PSD2, it should, not must today, but it should either hold authorization as a PSP provider under PSD2 when with an authorized PSP. In case of dual authorization, both as a CASP and PSP for the provision of services involving EMTs, actors are faced with a dual regulatory framework for engaging a single activity. When we transfer an EMT, you transfer an EMT. It is one business. Ben non, one business, but two hats. bad luck. In case of providing payment services through a third party, as an external provider, the regulatory burden is reduced, of course, but the cost of the service provided by the CASP increases due to the involvement of an additional actor in the provision of the service. In this context, the EBA is examining potential regulatory approaches for CASP that wish to provide crypto asset services classified as a payment services. One of the options under discussion is whether CASPs could be authorized as an agent. You see, the discussion is not, okay, it is a mistake, we will define differently and we consider that electronic money tokens are no longer qualified as a fund. No. The answer is, okay, maybe not as a payment service provider, but as an agent, which is more or less the same issue. But the discussion today is to consider whether CASP could be authorized as an agent as a payment service provider. Which is funny, if I may, is in the same time we have the PSD3 in discussion. Quick answer. You redraft the PSD3 and you say in the PSD3 that crypto assets are no longer or are not payment services or funds. It is easy. You just have to discuss this point on the PSD3. Surprisingly, it is not the case. Voilà. We have divergent position today between member states, which is not so good, regarding the interaction between MiCA and the PSD2. In the absence of the clear stance provides national regulators with some discretion, at least today. For instance, the ECPR has expressed opposition to applying PSD2 to CASPs, which is good. Furthermore, the EBA has indicated, pending a European level clarification, it does not intend to take enforcement, by chance, to take enforcement action against national regulators that choose not to apply PSD2 to CASP. Voilà. The discussion, we are not enforce you to oblige CASP to follow PSD2. And recently, again funny, if I may, the EU Commission sent a letter to the EBA in coordination with the ESMA, requesting the issuance of a non-action letter, which is quite rare, by the way, concerning the enforcement of authorization requirements under PSD2 for CASPs. In the case of CASP, are providing service involving EMTs. This request arises from concerns that certain CASP activities might, by chance, fall within the scope of PSD2. The proposed non-action letter would temporarily suspend the requirement for CASP to obtain PSP authorization when EMTs are used exclusively for investment or trading purposes, rather than as a means of payment. You see the distinction. The EBA has committed, with the ESMA, to publish this non-action letter by April 25, quite soon. It is expected to include clarifications on the regulatory overlaps between MiCA and PSD2 in alignment with the forthcoming PSD3 framework. Additionally, the EU Commission has indicated it intends to further clarify its position through a Q&A aimed at providing guidance on the application of this PSD2 for CAPS. Voilà. Just to illustrate the complexity of the situation when there is not a mistake, a political decision, which is a mistake as an economic point of view. And the answer is not to, okay, it is a mistake, sorry about that, we will, by chance, we are discussing on PSD3, we have the possibility to review this part of the discussion, we will clarify the fact that the EMT are not funds, but no, we continue to be in the same situation, and maybe there will be a situation where the CAPS could be an agent or a PSP, but voilà, it is nightmare. And just to continue to illustrate this nightmare, if I may, sorry to be, but for those who know me, I like to be in such situation. In fact, we have just illustrate two situations. The transfers of EMTs between accounts held by the same person. Right? Stephanie, for instance, you have accounts and you want to transfer EMT from one of your wallet to the other wallet or one account to another account. As of today, for payment services, the EBA has indicated that when an individual transfers funds between their own account bank, such transaction qualified as a payment transfer under PSD2. You transfer between two banking accounts, it is a transfer of funds. However, it remains unclear whether the same principle will apply to transfer EMT between you two wallets. We don't know. Custodial wallets provided by CASPs. This may qualify as a payment account under PSD2, provided that they facilitate the transfer of FEMT to and from third parties. And this is the situation that you illustrated. But it's just few words to say, in the EU, we made clear that we have now the MiCA, which is good, globally speaking, but policymakers, i.e. EU Commission, made a political choice. This political choice has other, for instance, the yield of EMT is a mistake, but we continue to be in the mistake. And even though we have the possibility to clarify the situation. This is something that I don't understand. Thank you. Oh, of course.
Thank you, Iber, for these very interesting points you made. So we talked about MiCA. Let's talk about what is outside MiCA. Stephanie already highlighted decentralized finance. We have a recital 22 in MiCA Regulation that states that if a crypto asset service is provided in a fully decentralized way, it does not fall under the scope of MiCA, even if recitals have not binding force. We consider that decentralized finance is not covered by MiCA. So Pierre, do you want to shed some light on decentralization and decentralized stablecoin protocols?
Sure. Thank you very much for the invitation. So maybe a first point, because everyone said that the toughest job in crypto is to be entrepreneur. I think also the toughest job is to be regulator, because clearly things are moving very fast, and this is really difficult to also fit with the actual state of the technology. And really, as an entrepreneur, the current state of the art in crypto is totally different to it was in 2021, and really, really different that it was in 2016, 2017, when I started as a member of parliament to work on it. So clearly, my point on regulation have always been to be pragmatic, to be open to what's going on. And as we are in a world of Latino law, it's really also difficult, and sometimes we don't, we love categories and so on that create also some friction. So decentralization is one of those categories, if I may add, and really the complexity is to determine what's a decentralized project. And you may have seen some decentralized protocols that say that they are immutable, they are working on their own, totally automatic, without any funders behind that. And that's pretty rare, because clearly in DeFi, currently the state of the art is that if you want to start building a protocol, you need to be centralized. You need to have a team behind that. You need to have someone that creates the first stone and build on top of that. And after that, maybe can converge to something that is decentralized on the long term. But really, that's not currently the major state of the art in DeFi. And so we cannot hide behind the decentralization to not be regulated, because I think it's a false objective. Really, I think that in the long run, maybe, yeah, the law will determine what should be the state of the regulation, what should be the protection for a decentralized protocol. But currently, we need to build also with regulators some common place where we fit with also what's the letter of the mission of the regulator. And that have been said very well before. Two things. First, protect the global system. And even if I'm not totally aligned with the fact that we put threshold and so on, yeah, there is a subject about this apparition of stablecoin in general, because it will have also an impact of the liquidity on the market for banks and so on. So that can also make things, we can think about it. And the second stuff is also protection of the users, of people who are investors and so on. So that's really, really important. So on decentralization, if I may just speak a little bit about that, you have few states of decentralization. First, a full decentralized protocol is something that is immutable, where you cannot change anything from the code that have been written before, where the founders or the builders initially are not able to modify the code as a contract. And DeFi is just about a contract. We speak about smart contract, but it's a contract where you just specify the rules of the execution of what will happen and so on. So clearly, the full decentralization exists, but it's pretty rare in DeFi. After that, you have the possibility to create different stadium, if I can say that, step of decentralization. First, there is automaticity of the system. The system are automatic, and you have no longer the centralization of someone, a supervisor, a curator, someone that is taking care of the transaction, just authorizing the transaction and so on. So that creates a lot of complexity, especially on KYB, because clearly crypto is about secondary market, it's about permissionless stuff, and having some permissionless network create also the incapacity to know very well who is behind a transaction, who is behind an address, and so you just have some criteria, some faisceau d'indices, sorry for the term in French, to determine if the transaction is legit or not. After that, at every step of each project, if you want to be decentralized, and for myself, my opinion is that, yeah, I think decentralization brings some positive aspect in finance in general. You start centralized, and you are a project that raise fund, you are a team that build a protocol, and after that, on the long run, you say, okay, my protocol is mature, all the actors that are participating in the protocol are well equilibrated, and so you decide to either give to the governance, so people that have the possibility to vote, and this is also another topic, because clearly, as you can see in democracy, there is a lot of challenge to have a fair and balanced and also efficient governance. It's the same for DeFi protocol, because the governance in DeFi protocol is not totally working well currently, because people are not really participating. You have different of interests. You can also, let's say, game the game. So find a way to go over the governance. So clearly, having a system that is democratic is something that is tough, and that if you want also to be efficient. So on the long run, I'm pleading for, yeah, a lot of discussion, I think, with regulators and institutions in general, because that's really a complex subject. Decentralization is not just a political view, it's also a matter of efficiency or neutrality. I really think that we can have also some infrastructure that are neutral, that are not governed by centralized interest or shareholders that are well known, and that offer also some common place or common good for a new step of finance. But really, this will not happen tomorrow. And clearly, DeFi currently is not totally prepared to be fully decentralized. And that's not bad, because clearly we have to reach also some new step to offer good product in an ecosystem that is clearly an innovation. For the moment, every people that are putting money in DeFi, I think should be protected, but less protected than someone that is operating with a bank, because the cost and the barriers at the entry is so high in terms of complexity that you cannot plead that you were not aware of this product. So we need to have better sandbox. We need also to have better discussion, sometimes with institutional actors and political actors, because I was one of them, and clearly the level of comprehension is really low. And the idea is that on the long run, yeah, maybe we should have some global term for the DeFi. And maybe a last point, because clearly this subject is clearly a subject about sovereignty, and the fact that we aborde MiCA as a defensive manner is also one part of the problem that we will see, I think, in the next coming months. because I think we will agree, Hubert, on that. In 2021, we were sharing the common view on stablecoin is also a monetary war, a monetary sovereignty. When you see Tether that have more than 115 billions of dollars, and behind that, a part is also T-bills that are financing the budget of the United States. You cannot consider that spreading Tether is not helping the US. And it's why US is okay with that, even if clearly we can consider that they are not totally regulated. They are okay because they can track also the transaction, and they also finance the debt of United States. So what I want for Europe, and I plead guilty on that because my stablecoin is denominated in dollars, so I will not speak too much about that. But I really think that in Europe, we have a chance to also have a clear state of the art in terms of law, in terms of regulation, and we need to take that to create also new I think champions, people that can build a really effective and powerful stablecoin network in euro denominated, because I think this is clearly what is the most important aspect if we want to be sovereign on our dear currency.
Thank you very much, Pierre, so for your insights. And Mathieu, what is the opinion of ACPR on decentralization?
Thank you.
Briefly.
Yes, briefly. Concerning DeFi, MiCA is not enough clear that on what is inside the scope or what is outside the scope. This is very difficult to know because there is no clear criteria. A lot of people think that because there is no real issuer, DeFi services could be or should be excluded from the scope of the regulation. But in fact, where there is an entity of a group of persons able to implement some change on the protocol, the question to request an authorization for this entity arise, in fact. So at ACPR, consider DeFi as very risky in terms of anti-money laundering, of course. Also, because without any rule to protect the user, we think this is also very highly risky for them. And that justify our close monitoring of all so-called decentralized issuance of stablecoin. Even if there is no real issuer, in fact, it is possible to regulate DeFi. Last year, with the ACPR, with our colleague of the IMF, we did a working group on the topic of the certification of smart contract used in the DeFi, and we try to find a way to implement such a certification in a European legislation. So the report contains 3 parts. The first one on the main principle of a standard. The second on the different options to make audit of smart contract. And the last one on how to implement such a certification in a regulatory framework. So the report, there was a consultation, a public consultation, which ended on the 10th March, and the result of the consultation will be released before July. So maybe we will have a good proposition. We will see. Thank you.
Okay, thank you very much. So let's talk about the global implications of MiCA. Pierre touched upon this point and talked a bit about the competition with global players. Stephanie, what do you think?
I fully share your views, Pierre. On the MiCA is really a powerful tool in terms of sovereignty. Why? Because first, it enables Europe to ban non-regulated stablecoins, meaning stablecoins which do not respect the rules we have inside the EU. So one example is a USDT, so the Tether stablecoin, which is the biggest in the world, is currently being banned from Europe. It's not possible for Tether to issue it in Europe, and it's being delisted from all crypto exchanges, brokers, etc., all around Europe. So it's a powerful tool to impose to third countries our rules. But at the same time, it should be also a way to foster the use of stablecoins. Why? Just because what you explained. Stablecoins are a mean to collect liquidity from all around the world, from retail people, from professionals, from everyone, and to invest it locally in your country. Why is the US promoting stablecoin and forbidding CBDC? This is exactly why. Because stablecoins, everybody currently uses dollar stablecoins because they were the first to be issued in the world. So dollar stablecoins collect liquidity directly from people without all the intermediaries, without losing money in the way. And all this money is invested in the US in treasury bonds. Tether, so the issuer of the USDT, is the 18th holder. No, I saw indeed. Fourth, well, maybe fourth. Fourth holder of treasury bills in the world. One company of 100 people holds more treasury bills than the whole Germany or than the whole Australia. I don't, you know, when I learned that, I was really baffled. One company has more power than all the financial players, all the retail people, everyone in Germany. So you see, so the potential in terms of financing public debt, companies, defense, etc., is absolutely huge. And that's why I'm speaking about that, because in reaction to this US stance to promote stablecoins and forbid CBDC, we have now in Europe, I feel, a debate which is CBDC versus stablecoin on the other way, meaning that in reaction, we are very strongly in favor of CBDC and against stablecoin. For me, we absolutely need both assets. We need CBDC for financial stability, for wholesale transactions. It's absolutely key for financial stability. But stablecoins are the new way, the new commercial money. And this is also something absolutely indispensable if we want to finance our future economy and have a strong economy in the future.
Thank you, Stéphanie. Hubert, could you please explain us the regulatory policy in other jurisdictions, for example, in the US or the UAE?
I will maybe just add some one of two other figures with Stéphanie. We saw a few minutes ago the total volume per day exchanged on Tether. If I remember well, it is $40 billion per day. Am I correct? 30. Yes, which means the double volume on Euronext, just for one stablecoin. Just to imagine. Voilà. This is interesting because usually we compare the market capitalization of crypto assets with the market capitalization of shares or other financial instruments. It has no sense for stablecoins. Stablecoins are more comparable with legal money, legal tender in circulation. And in this case, if you look about total capitalization of stablecoin, 250 more or less billion of dollars. What is the total amount of USD in coins and in banknotes in circulation? 3,000 billion USD. I.e., is not so far. 3,000 billion USD in circulation in form of coins and banknotes compared to 250 billion stablecoin. And then it is more comparable. To come back to your point, interesting to see in the Emirates, specifically in Abu Dhabi, they have enacted last year a stablecoin regulation or law, which is inspired by MiCA, but not with those issues, if I may, because it is possible to bear interest on the Emirates. It was clearly a political choice because they saw what happened in the EU, and they say, okay, we know, but we do differently. Same for the reserve. Of course, the reserve is very well monitored, but with, if I may, more flexibility in one sense compared to the EU. What about the US? You know, we have these two draft bills. The one is named Stable, and the second is named Genius. It's not me. Huh? And the Genius bill is very interesting because it is a draft, but it is a co-partisan draft between Republicans and Democrats, which is quite rare, specifically today. And these bills, not bills, these draft bills has been discussed last week to the Banking Committee of the Senate, and the Banking Committee has agreed on the content of the draft bill, which means that this draft bill will be discussed now to the Senate as a whole, and potentially it will be the next bill in the US. And interesting to see about the changes after the discussion at the Banking Committee of the US Senate. If I saw my notes, sorry, because I am not a US lawyer. The definition of payment stablecoin has changed if we compare with the first draft, because in the first draft it was possible, but it was not prohibited differently to bear interest or to bear yield. After the Banking Commission, there is a prohibition. As for the EU, surprisingly or not, stablecoin issued under this Genius Act will be prohibited to bear interest or yield. And what does it mean? That means stablecoins that are not governed by the Act, i.e. stablecoins who offer yield or interest, cannot be used for interbank settlement. This is something of the changes after the Banking Commission. Something interesting again is AML. You discussed on the AML. Issuers will be treated as a financial institution under the Banking Secrecy Act with additional AML sanctions protection. But rules will be tailored to the size and complexity for each issuer, which is not one, is flexibility, if I may. Governance, we see something similar than in the EU. Stablecoin issuers with balances of greater than 50 billion USD must get an audit. You remember that the discussion about Tether and the audit 2 or 3 years ago. It is now those who want to get the protection of the FDIC must be audited. But just to be short, that the Genius draft bill is a very important one. I post quite often on LinkedIn on this topic because it will clearly be the next and the future regulation in the US. They saw what is the MiCA regulation. They are doing a little differently than us, but the discussion about interest and yield is, I'd like to investigate myself because it is something new that it was not happened. And why they have changed in their mind, I don't know.
Perhaps to protect the banks?
Perhaps to protect the bank, perhaps. I don't know, but perhaps usually it is the answer.
Okay, thank you very much. Do you want to add something? So, thank you very much for your insightful discussion. Perhaps the audience will... Do you have any questions? You have a micro?
Thank you for the discussion. I have one question concerning what you said, Stephanie, about the non-yield on stablecoin. Why it has been decided and by whom? And second question, Tether doesn't provide any income, or I say something wrong. So the biggest stablecoin, which is completely unregulated, according to me, doesn't provide any yield. So it's a little. Sorry.
It's not native.
It provides yield, and when you hold it on crypto exchanges, you get yield from the liquidities you have.
From Tether.
Ah, yeah.
And they provide how much compared to what they get? When you met
They don't have
13
audited
billion.
accounts.
Sorry?
You know how much?
No, I don't know exactly. I think it's 20-25% because you just have to compare with the revenue and after that you just take a look to the TB right, and after that you know what they keep and what they left.
And the yield in crypto exchanges, it's generally between 5 to 8%.
Yeah.
Oh.
Yeah, because you have different. That's also the difficulty with a stablecoin issuer, because sometimes they have loan lines, so they lend their stablecoin to other institutions. We don't know if they are 100% collateralized. I bet that, let's say in 2019, 2020, Tether was not fully collateralized, and maybe give some loan, so print some Tether USDT to some certain actors, let's say market makers and so on. And the risk-free rate in crypto is around 12%, between 10 and 12%. So you have a lot of actors, financial actors, that are okay to pay 12% interest just for having some stablecoin. So a part of the business of Tether also is to lend a part of the supply. The question was mainly, was this supply was fully collateralized at the moment? I think now yes, but that's really an open question for the past.
Just to try to answer to your question, who has decided? But again, we come back to the question of definition. If we consider an EMT as a money, you know that the money cannot be remunerated as itself. An account, a banking account, can be remunerated, but the money itself doesn't produce any interest. It is the account which produces interest. By whom? By the account provider, by the bank. It is not the state, the ECB or any central bank who give remuneration on the holder. And which is strange in the reasoning is, in one sense, some consider that EMT are not, which is true, legal tender, is not money, but the reasoning to prohibit remuneration is to consider as a money. It is totally strange.
The origin of that is exactly what you say, is that some people consider stablecoin as money, and money don't create interest. But at the same time, the problem is stablecoin is between the two. It's also it's a money, but it's also like an investment product, and basically it generates yield. It's a fact. When you immobilize the reserve account, the reserve is creating money. So there's no justification at all that this money created with the savings of investors is not given back to the investors and is captured by financial intermediaries. Politically, there's no rationale behind that. So the problem, as you said, Hubert, is exactly that, is that we wanted to apply two regulatory frameworks and two notions on stablecoins, money and financial asset, whereas we should have fully engaged in the direction of defining a new crypto asset. Voilà, it's a new asset, it's something totally new. And we create a regulatory framework only for that. And we recreate a transfer of fund regulation, etc. So without this clear definition of a stablecoin, we won't be able to really capture this new notion. And this is important because this is a new money on chain. The new money on chain will be a money which creates yield. This is how it should be.
This is why I said, sorry, to continue the discussion, it is a mistake. It is not only, it is not a political mistake, because a political mistake is never a mistake. It is a decision. It is a mistake. It is a legal mistake, in the sense that it is money or it is assets, but it cannot be both. If it is both, it does not work.
If I may add something, the official justification in MiCA Regulation, because if you read the recitals, they say in order to ensure that stablecoins are means of exchange, even not means of payment, and not means of store of value. So this is the official justification. Yeah.
Maybe I will be the lawyer of the devil. No, but I also get the point, because in certain sense, you don't want to unbalance the financial system. Because if you are saying, okay, stablecoin yield the money market fund rate, and the money market fund rate is not totally accessible to retails currently. A lot of people are losing a lot of money because they're not hedging their met even in a bank, you know. So clearly, you're offering a product that is very effective for retail, for users, but you can create also traction from banks to stablecoin issuer that can lead also to an unbalance of their balance sheet and create also some disparity in the whole economical financial system. So I understand the point, but really we'll need to find a way, because especially for TradFi, there is no way. If you are speaking to an asset manager, a stablecoin is something that shouldn't exist, because you don't give money to someone without finding any interest. And Tether is that. Tether is yielding all the money for themselves and exist also with that because it offers another product on top of money. The product is payment, is trading counterparties and so on. But clearly, in general, is tomorrow you have some money market funds that are, let's say, distributive, so pegged to $1 and yield at least the risk-free yield of the underlying. You will not have any purpose of having Tether, because Tether is not efficient in terms of financial design.
Thank you. Other questions? No? Oh.
Thank you very much. Maybe a question about the same topic. I guess that in the electronic money the electronic money directive, you can have yields on the money, electronic money, not EMT, electronic money directive.
It's prohibited.
Because
this is the difference between EMD directive and payment services directive. And it is quite easy to understand, if I may, because it is the same reasoning, to be short. Electronic money is viewed as a money, even though it is, legally speaking, a mean of payment. It is viewed, economically speaking, as a money. And this is why the money doesn't produce, per se, or itself, remuneration. But the question is, why not considering that the account of electronic money can produce interest? Not the money, but the account provider. But the electronic money directive prohibit, and this is why we have this prohibition too for the MiCA, because MiCA refers to electronic money directive.
Because actually, I had to do the research about where does it come from, and I saw that on the MiCA project, the first draft, there was no prohibition of interest yield. It appeared actually when the European Council had the Commission text. So it was actually my question. Isn't it political? Isn't it something that has been...
Between you and me, it is the ECB, to be short.
Because it was not in their report.
No,
the ECB didn't talk about yields in their report.
Huh?
It was not at ECB. It was
No,
of the council.
Of the council, yes, but pushing.
It was longly discussed, this question. So that's true. So EMD, electronic money, is surrogate of bucks and notes. There is no interest. And yes, it was a long discussion at the council, and if it's forbid, it's because there were more countries who voted against that. It's true. Maybe it's not a good decision for the business. I don't know, but it is true.
Okay. Thank you very much.
Other questions? Thank you very much. Thank you very much for your valuable insights and very interesting discussion. So the discussion can continue over the cocktail. So I invite you to join us. Thank you.